Okay, let's talk more now about the capital asset pricing model and the security market line equation. Remember, those two terms are pretty much the same thing. So this is the same equation that we were looking at just a few minutes ago. Notice that, again, just to review, we've got the required return on stock I, or whatever the stock may be, is going to be the risk-free rate plus this term in parentheses, which is the market return minus the risk-free rate of return, and that quantity will be multiplied by beta. Now remember, I did say that this term in parentheses has a special name which we call the market risk premium, or the risk premium on the market. And so sometimes, instead of writing it out completely this way, we will say that this is just the market risk premium times the beta of the particular stock that we're talking about. So the security market line CAPM equation actually can be written here two different ways, and I want you to be very careful about this, because there are times when in a homework problem, for example, you may need to use one equation or the other. So you should be familiar with both, certainly. But another thing that you have to keep in mind is that sometimes a particular homework problem might refer to the market risk premium, in which case you're going to be using this lower equation, all right, because it actually has the market risk premium spelled out right here, very specifically. Whereas other times, the problem might refer to the expected rate of return on the market. They might call it the average rate of return on a typical stock, or the expected return on a mutual fund that contains all the stocks, or the market portfolio's required return, and that would refer to just this. Okay, that would refer to RM, and from that you would actually have to subtract off the risk-free rate. But if they just said the market risk premium is a certain amount, then you would use this form, which would not require you to subtract out the risk-free rate again, because it would have already implicitly have been done. So do be very careful about which form of the equation that you use, and use some caution there. Word of the wise hopefully should be sufficient. We're going to go through an example here where the risk-free rate is going to be 5.5%, and the market risk premium is going to be 5%. Let me give you a little quiz here just to check your understanding. If that's true, the risk-free rate is 5.5% and the market risk premium is 5%, then what would this market rate of return be? I'll give you a second to think about it. Hopefully you don't need too long, because the answer should be 10.5%. Okay? If the risk-free rate is 5.5%, and the market risk premium is 5%, then the market rate of return is just going to be the sum of the two. If you didn't know the answer to that right offhand, that's okay for now. Let's talk about what the market risk premium is. Remember that if you invest in the market portfolio, you're still taking some risk, right? The market portfolio, which is like that 5,000 or 6,000 stock mutual fund that I referred to earlier, it is not risk-free, no question about it. You are taking some risk, and so you would expect, and in fact you would require, that if you're gonna do that, it had better on average pay more than the risk-free rate. Otherwise there's no really good reason to do it. Okay, you would just take the risk-free rate of return. and forego the risk. So the additional return on that market portfolio is this market risk premium. And how much is it going to be? Well, it kind of depends. If investors think that the stock market is really, really risky right now, then the market risk premium would probably be higher. Okay, if they don't feel it's very risky, then it'll probably be lower. It also depends on investors' appetite for risk, and on the flip side, I guess you could say their degree of risk aversion. All right, if investors are really risk averse, that is, they don't want, they really, really don't like to take risk, especially at this point in time, then that market risk premium is going to be higher. Okay, they're going to demand more of a return in order to induce them to take a given level of risk. On the other hand, if they're not quite as risk averse right now, they're not really that afraid of the market fluctuations, then the market risk premium won't be as high. So in numerical terms, how much is it? Well, it depends on exactly which data you're looking at, okay, which time period you're looking at. But if you gave me a number between 4 and 8% per year, I'd have a hard time arguing with you. That it would be reasonable. That would at least be pretty close to it. So if you look at any given point in time and you look at the difference between the average rate of return on the market and the risk-free rate of return, it'll tend to be in that window, okay, 4% and 8% per year, okay. And keep in mind that some years the market will perform very well, and some years it'll perform very badly. So you have to look at long-term averages really to make a meaningful comparison here. All right, so let's use the CAPM to find the required rate of return for the high-tech stock. Remember we said earlier that the beta of the high-tech stock was 1.32, and you don't have to calculate that, at least not in this course anyway. In a more advanced course you might need to know how to do that, but you can take a look at exactly how to do that later on, in a more advanced course. But in this case, let's just say we know that the beta is 1.32. Well, then you would multiply that beta by the market risk premium, which we said was 5%, and that would give you about 6.6%. And then you'd add that to the risk-free rate, which we said was 5%, and the result would be a sum of 12.1%, and that would be the required rate of return for this particular investment, for the high-tech stock. We could do the same thing for all the other stocks as well, not only the high-tech stock, but the market portfolio, U.S. Rubber, the T-bill, the collections company. And notice that the only thing that is different is the betas. Notice that the risk-free rate is identical in all the calculations, as is the market risk premium, because that stuff is not specific to any one firm. That is determined economy-wide. All right? So the only thing that is really different would be the betas of each individual investment. And again, this is not something that I'm going to make you determine via a regression, because this is just the introductory level course. So this is assuming you are given these betas, assuming you know what it is. You could basically carry out the same calculation. Okay, like for the U.S. Rubber Company, 0.88, if that was their beta, you'd multiply that by the market risk premium of 5%. That would give you a 4.4%, which you would add to the risk-free rate of 5.5%. Give you a total of 9.9%. Okay, that would be pretty straightforward. And then we already said earlier that that the market rate of return had to be 10.5%. Okay, why is that? Because it's the risk-free rate plus the market risk premium. I know we're multiplying by beta here, but the beta of the market portfolio is always 1, so that actually wouldn't affect anything. So we just have the sum of those two, and we'd have 10.5%. The T-bill, that was an easy case because of the beta of 0. This part of the equation basically falls out, and we just have the risk-free rate of 5.5%. And then on the collections stock, this was the case that in the beginning of the chapter seems so unusual. It just didn't seem like it should be this way. But turns out that it's easier to explain in the light of this market risk thing. Okay, understanding that this stock has a negative beta. It moves in the opposite direction of the market, and so it actually has an insurance effect for the rest of the portfolio, and that's why people are essentially willing to pay for that insurance by accepting this lower rate of return. See, it has a negative beta, negative 0.87 times the 5% market risk premium is actually going to be a negative number now. Okay, and then that negative number added to 5.5% actually ends up with only 1.15% for the required return. Okay, so we've used the CAPM security market line to determine the required rates of return on each of these investments. Now what I want to do is briefly look at the difference between the expected return and the required return, because they're not quite the same. Not always. They're not quite the same concept. In equilibrium, if everything is fairly valued, then they should be the same. And in fact, you do see a couple of cases here where we are in equilibrium and things are fairly valued. Take a look at this case. In this case, again, those actually are equilibrium cases, and the two numbers are the same. Okay, the expected return equals the required return. But in other cases, we have small deviations from equilibrium. The expected return, let's do the high-tech stock, is 12.4%, meaning that if you look at the actual probabilities of all the outcomes and the payoffs for each outcome, then on average this stock would pay you back 12.4%, a 12.4% return over time. Whereas if you take a look at the required return, it's 12.1%. Now what does that mean? It means that given the risk level of this stock, 12.1% would be a fair rate of return on average. Investors would consider that a fair rate of return. But given the actual probabilities, it's likely that they would on average see 12.4%. So is that sufficient? Oh yeah. Yeah, it's more than sufficient, in fact. The expected return is higher than the required return. That would make investors happy, and in fact that would make this an attractive buying opportunity. Okay, and in the same breath we could say that the stock is undervalued. It's underpriced. It is a buying opportunity for investors. This is a stock they would want to purchase. You purchase things that are undervalued rather than overvalued, certainly, and that happens whenever the expected return is greater than the required return. And you'll learn more about these valuation relationships for stocks. So how a stock's actual value is related to its required return in the next chapter. Now, in a couple of cases on this chart, the opposite is true, such as, let's look at the collections company stock. The required return is 1.2%. All right, 1.2% is the required return, which means that would be a fair rate of return given the risk level of the stock. And the expected rate of return, based on our best estimate of the probabilities and the payouts, is only 1%. So is that sufficient? Yeah, the answer is no this time. And I could say the same thing about U.S. rubber, where a fair rate of return would have been 9.9%, but the expected rate of return based on probabilities is only 9.8%. Again, that's not quite sufficient in either one of these cases. The expected return is less than the required return, and that is not good from the perspective of an investor who's thinking about buying the stock. And in fact, an investor would probably choose not to buy a stock like this. In this case, the stocks would be overvalued and they would not be attractive investment opportunities. Graphically, I could actually plot the security market line if I wanted to. Notice here, again, this is the equation. It's the risk-free rate plus the market risk premium times the beta of the individual stock. That gives us the required return. In this case, we know the risk-free rate, we know the market risk premium, and the risk-free rate is the intercept, which is right here, and then the market risk premium, 5%, is the slope. Okay, notice that if the beta increases by 1, then the level of this line, the rise, I guess you could say, it's rise over run is the slope. It increases, the difference here is 5 percentage points. Okay, so that's your that just goes back to your classic algebra equations, I guess, for the equation for a line. Well, anyway, if I plot that line and I also plot these individual investments, look at the high-tech stock. If I plot its beta of what did we say its beta was? We'd have to go back 1.32 for the high-tech stock. Okay, so if I plot its beta, which should be about here. That may be just a little bit off scale, but let's just say that's 1.32. And then I look at its expected return. I plot its expected return instead of its required return. I would see that that's a little bit above the security market line value, which means that actually this would be a good buy. Okay. The U.S. rubber, on the other hand, plots a little bit below the security market line, as does the collection company stock. Okay, anything that is up here in this region, okay, above the security market line, anything up in the region above the security market line, that would be potential buying territory. Okay, that's where the stock is undervalued. It's a good buy. The expected return is more than the required return. On the other hand, anything that is below, okay, so down in this area, below the security market line, that could be selling territory. Probably wouldn't want to buy those investments because the expected return is not equal to the required return. Now, I know that for these investments, I was saying, well, for high tech, you should consider buying that one. For U.S. Rubber, consider selling. For Collections Company, consider selling because it's overpriced. In reality, if I ever did a real life analysis of these companies and I found expected returns this close to the required returns, I mean, if you look at this slide, I mean, what are the differences here? 0.3 percentage points for the high-tech stock. You know, this is not much of a difference. This is definitely not much of a difference. 0.1 percentage points. If I ever saw this, then in reality I would probably say, it looks like these stocks are pretty close to equilibrium. Okay, so I'm not really suggesting that if there's even a tiny deviation from the SML that you should immediately rush out and try to buy or sell. But if there were large deviations, you know, if the required return based on the SML were in the 10% range, and yet the expected return based on good estimates was more like 15 or 20%, then I would think about it. But those situations are probably going to be hard to come by in an efficient market. Okay. I want to talk now about you know, we did this beta thing for individual stocks. Let's talk about how to get the beta of a portfolio. Okay, I know that the beta of a stock indicates its risk in the context of a well-diversified portfolio, but let's say we wanted to get the beta of a portfolio itself. Well, that would really be very easy. Let's take our old example of a portfolio of half and half, 50% high-tech stock, 50% collection stock. Well, the good news here is that it is just a weighted average. So if you know how to find the expected return on a portfolio by taking a weighted average, then you can do this too. This is so simple. It's definitely not anything like finding the standard deviation, which was more time consuming. So we just we note that the beta of the high-tech stock is 1.32. That was given. And the beta of the collection stock is negative 0.87. That also was given. Then it's a 50-50 mix, so those are the weights, 0.5 and 0.5. So we just multiply each beta by the weight on that stock, and then we add the two results together. It's a pretty straightforward calculation. Most likely you can do that by now, by this point in the chapter, and so your result would be 0.225. That would be the beta of the portfolio. So then, what do you think would be the required return on that portfolio? Two ways to get it. Okay. One way would be to take a weighted average of the required returns on the individual assets. I mean, we did calculate that earlier, right? On a previous slide, it was this one, okay? We found the required return for the high-tech stock was 12.1%, and for the collection stock was 1.15%. So if we wanted to just go back here and take a weighted average of those two, all right, so here's the 12.1%, here's the 1.15%, and we want to multiply each of those by 0.5. Since those are the weights, you got half your money in each one, then you would get 6.63%. It's the weighted average of the two. That would be the portfolio's required return. But there is another way to do it, right? Let's take a look here. Remember, we did just now calculate the beta of the portfolio, right? It was 0.225. Correct? Okay, so we could just use the CAPM equation. Since we know how to use that now, we could say the risk-free rate is 5.5%, the market risk premium is 5%, and the beta of the portfolio, I mean, if we can plug in the beta of an individual stock here, we can do the same thing for a portfolio, and it's 0.225, so we just use the CAPM equation like we would for an individual stock. Since we now know the portfolio's beta, it's not a big problem at all. So 0.225 times 5%, and then add 5.5%, and we get the required return on the portfolio. Same answer, 6.63%. It does not matter really which method that you use. Either one will lead you to the same answer. You can either find the beta of the portfolio and then use that in the CAPM equation to get the required return, or you could first use the betas of all of the individual investments here, okay, like we did on this slide, and then well, in this case it would just be those two, and then you could use the required returns resulting from that equation as in the method up here at the top. Okay, you could use this method, just take a weighted average of each. So either way is just fine, and they will both lead you to the same answer.